Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another and final edition of All Things Financial for 2014. The next time we're on the air and that you'll see the videos will be the beginning of the year 2015. So it's been a very hustle-bustle year. It's come fast, come and gone almost. And what I was doing in the last show and wanted to continue on this show was a wrap-up of a concept for year-end strategies, financial strategies, which included gifting and things like that. So what I brought up last week and what I wanted to bring up this week were some really year-end, you still have until December 31st to take advantage of some last-minute financial opportunities, either tax-saving opportunities, income shifting, and things like that. So I wanted to first remind everyone who is over the age of 70 and a half, if you turned 70 and a half this year, 2014, you have until the end of this year. It's kind of a two-part rule, and I'll give you both parts. You have until the end of this year to take your first required minimum distribution, or you can extend it for the one-time first year only after turning age 70 and a half by April 1st of 2015 to take your first required minimum distribution if you have any qualified IRAs or 401ks and you're no longer working. Now, the problem if you wait and use that extension to April 1st is you still have to take your year 2 distribution by the end of 2015. And what that would mean, if you don't take the first one by this December 31st, you'll actually have 2 IRA distributions packed into 1 year. The problem with that might be you're forcing too much taxable income, double, in essence, of what's required, all into one tax year. If you take 2014's, not until next year, and then have to take the 2015 also in next year, it could raise your taxable income high enough that more of your Social Security would be taxed than is supposed to be. So my recommendation is contact your tax advisors and do the analysis on, is it better if you just turned age 70 and a half this year to wait until next year and take double, or to take the one distribution this year that's due for this year and then only have to take one next year? Would it help keep your tax rate a little lower? But I will tell you, anyone who is over the age of 70 and a half and has an IRA, traditional IRA, this does not apply to Roth IRAs, or a 401k, traditional 401k, or 457 plan or tax sheltered annuity if you're a teacher, any qualified retirement plan, and you have turned or already exceeded the age of 70 and a half, the penalty to not properly withdraw, and you only have to withdraw based on your life expectancy, the percentage of the total asset that would equate to 1 year of your remaining life expectancy has to be pulled out of those funds, or you're subject to a penalty of 50% of whatever was supposed to have been pulled out. So let's say you're age 72 or 3 and are hearing this for the first time and realizing you've missed 2 or 3 years of withdrawals or distributions that are required. If you were to go back and create or calculate how much was supposed to come out, and you find out it was supposed to be maybe $5,000 a year, roughly, and you've missed 3 years, that's $15,000. You have a problem because, or potential problem, because that means you might owe a penalty. In addition to pulling the money out and paying tax on the proceeds, you might also owe an additional 50% more of that $15,000 for the 3 years for not taking it out timely, which means it's costing you tax and an additional $7,500 penalty. That's a steep penalty, folks. So when you get aged 59 and a half, that is the trigger age for when you're first able to take out from a retirement plan without penalty for premature distributions. But once you turn age 70 and a half and have exceeded that amount and not taking distributions, there's another penalty for waiting too long to take distributions. So be very careful. The premature penalty prior to age 59 and a half is only 10% of what you pull out prematurely. But boy, that penalty by waiting too long and never pulling it out, thereby never giving the IRS a chance to get paid their tax, they penalize you 50%. So that's quite onerous. Now, how about some other year-end tax issues? One of them we left last week off with was gifting. And I wanted to get back to that. Remember last week we talked about you're allowed to gift up to whatever you want, and I've said the rules typically state you're allowed to gift up to $14,000 a year. I hope I cleared that up last week, where you're allowed to gift more than $14,000 a year. It depends on your tax bracket. So talk to your tax advisors. But you are allowed to gift up to $14,000 a year before you have to report it for gift tax purposes. So if you have any questions on that, go back to last week's show. And I wanted to continue along that theme because we are at year end. And once December 31st comes and goes, you can no longer utilize this exemption for 2014. So you could gift up to $14,000 a year, but what I didn't talk about last week in detail was what are you allowed to gift without reporting it, and what are the most advantageous gifts? So let's get into that this week. You're allowed to gift stocks, bonds, cash, clothing. So we get into charities, we get into gifting to other individuals, and it matters what your purpose is for us as financial planners to be able to help you calculate or determine which is the most efficient asset to gift. Let me give you an example. Let's say you have $14,000 of cash you're looking to give to a church for a year-end donation that you're going to deduct on your income taxes. Now, what if you have stocks that you paid $14,000 for that are now worth $28,000? It's a gift of your cost of $14,000, but benefits the charity to the extent of what they could sell the stocks for, which pretend today's value would be $28,000. Now, if you sell those stocks yourself, if you've held those stocks for longer than 1 year, you would pay a long-term capital gains tax rate of typically 15% on the gains. For high-income earners, it could be as high as 20% and even higher with the Medicare tax. But for the rest of the people listening, it's 15%. So you look at, and I've gone through this on prior shows, capital gains tax rates. For the majority of us, we think 15%. But please don't forget what I went over in a show a month or two ago about capital gains tax rates being 0. And those of you listening are wondering, wait a minute, is it 15%? Is it 0? So I'll refresh you on the rule. The rule is important when we get to gifting on which assets you might want to gift to charities and which assets you might want to gift to other individuals, like grandchildren or children. Gifting to charities, once the charity receives whatever the asset is, if it's a qualified 501c3 nonprofit charity, whatever the asset is, once they sell, they don't pay any income taxes. So a qualified nonprofit charity does not pay income tax. That means you could gift low basis or low cost to you what you initially paid for an asset. Let's say these stocks that you paid $14,000 for, and they're worth $28,000 today. The charity sells those stocks and receives the whole $28,000, where you in a 15% tax bracket might only receive, let's say after your expenses, stock brokerage fees to sell them, and taxes, you might only receive $24,000, let's say. So we have issues to consider on what are the most efficient gifts. Well, what about stocks that you bought only 6 months ago and they were $14,000 and $28,000 is their current value? Well, my first thought is congratulations to you, because if you found a stock that you paid $14,000 for only 6 or so months ago and now is worth $28,000, you deserve congratulations. Now, how do you maximize the value of the stock? You might say, I want to sell the stock to keep the gain because the stock might go down. But if you sell that stock yourself, having only purchased it 6 or 7 months ago, you're subject to ordinary income tax rates on those gains, not capital gains, not long-term capital gains rates of 15%, let's use in this example. But rather, you might be in the 28% income tax bracket. So you might owe 28% tax on the gain. So you'd look at that and say, I'm losing almost 30% of the gains. If I donate that stock to charity, they would get 100% of the gains. So you have to look at this situation in different ways. Let's look at something else. If you're in a 15% income tax bracket and you want to donate the stock to your grandchild, well, if you donate by way of gift, which is the only way to really you can donate, it's by defined as a gift. What happens is if you paid $14,000 for the stock and it's now worth $28,000, and it's a stock that you want them to keep for years to come, if you gift it to them, they actually receive that stock, $28,000. They don't sell it. You just gave them the shares. And they still owe tax whenever in the future they sell on everything over what your cost was into the stock, which in this example was $14,000. So if that stock is someday grows to $50,000, they'll owe tax on $36,000 gain. So the more it grows, the more tax they'll pay. The risk is this. Well, there are a lot of risks, but one risk is assuming that's no problem because it's long-term capital gains. They'll only owe 15%, and so they'll be okay. The fallacy in that is assuming long-term capital gains rates will stay favorable at only 15% maximum, which we've seen in past history. It's been 20% and even longer. We've seen proposals in Congress to take away the favorable tax rate for long-term capital gains altogether for stocks. So please don't rest under the false assumption that 28% will stay 28% or 15% will stay 15%, because none of those tax rules or tax laws are probably permanent. So we want to be very careful in our future planning based on present laws, because we're destined to make mistakes. We just don't know how far off we'll be. Now, there are other strategies. One, instead of gifting the stock, you can will the stock. And if you do so, then by virtue of the grandchild inheriting the stock, there's what's called, under current law, a step-up in cost basis. And what that means is if when you pass away, they inherit the stock, which is now worth $50,000, and you had a $14,000 cost basis, they would typically, or you would have prior to death, if you sold this stock, you would have owed tax on long-term capital gains rates of $36,000 gain. And if you gifted it to them and they sold the stock, they would owe tax on the long-term capital gain. But if they inherit the stock, this cost basis gets erased, your old cost basis, they establish a new cost basis called a step-up in basis. Their cost for IRS purposes is actually the value of the security, the date they received it, or the date upon death that it was inherited. So their cost by IRS measures under current law, because we have this step up in cost basis provision in tax law, their basis or cost is deemed to be $50,000, which means if they then sell it the day after they inherit it, and I use the day after loosely because of probate, if you inherited it by will as opposed to a living trust, we won't get into all of that, you will see them being able to inherit a stock worth $50,000 or a stock portfolio worth $50,000, cash it in the next day, hypothetically as I speak, and owe no income, no federal income tax. Now again, there are estate taxes, there are Pennsylvania inheritance taxes. This is very complex. So the areas that I'm pointing out at year end, you can gift up to $14,000 of something, but the question is what thing is going to be most benefit. So here's another thought. And the reason I bring these all up to you all throughout the show are to prove a point to you that you cannot make the best financial decisions for yourselves, making the most out of your money, without first assembling a team of highly skilled financial planners, tax advisors, legal advisors, and insurance advisors. Assemble a financial team to help you make these very complex but highly beneficial decisions that occur in everyday life. I bring them up on the show to help illustrate all the strategies that are available, and to try to get the point across, call us as implementing us as one of the members on your team. We can even help you assemble other members of your team and help you make much better decisions than you can make on your own, deeming a lot of the advice highly valuable, especially at year end. How about this one? Somebody says, I have $14,000 and I want to gift it. And we, as a financial planner, say, gift it for what? And they'll say, I might want to do college funding for a grandchild. And we'll say, well, you're 70 years old and you're healthy. Have you ever considered taking that $14,000 and applying it toward an annual premium for life insurance on you, the grandparent? It might buy $100,000 or $150,000 death benefit, maybe $200,000 if you're lucky, if your health is good. But you would look at that and say, you might be able to leverage the gifts as opposed to giving dollar for dollar in cash to the grandchild to save for their college. You might be able to leverage it in a life insurance policy where you'd say, I'll gift $14,000 a year, but it might buy $150,000 or $250,000 of death benefit immediately upon my death. So whether my death is now, 10 years, 20 years from now, if you're 70 years old, you're playing the odds that within 18 years from now or 19, when the child goes to college, that would have paid out, or there'd be enough cash value in there if you buy a whole life policy, let's say, that could still fund the college education as a living benefit, retaining the remaining death benefit there, getting a much higher value than $14,000 every year gift-wise, plus its earnings might have attained. So you want to do that analysis too. I mean, you might be in a case where it might buy more insurance than any other alternative on growing for their college or future needs. So you could think about that. And I want to share another idea with you since we're getting close to the end of the show, and it's based on a legacy. I did have a case, and I want to share this with all of you who are thinking about what to do with your own life insurance that you already have in place. I saw a case, it still exists today, that was created in the mid-90s where someone carved out, the husband actually carved out about $35,000 of the death benefit to establish a trust fund for future college and education needs for all the grandchildren. And the fund was created, $35,000, and there was growth, and they had carved it out where they said any grandchildren that are born share a pro rata percentage. So if there were future grandchildren, they would add to the mix, and at any time one grandchild got to college age, they would receive 1/5 or 1/8 or 1/12 or however many grandchildren there were at the time of what the balance was. And we have watched this over time perpetuate itself. It has helped. There were many more grandchildren than were expected. It turned out to be like 23 grandchildren. And each one of these grandchildren, because so much time had elapsed, and they had time to grow, and you just ran into all these grandchildren. Each one of those, you saw a legacy at least benefiting 23 grandchildren to some extent. Whatever the extent isn't as important as your ability, if you choose to benefit future generations through your beneficiary designations like that, is something to think about. So when I say maybe creating your gifting strategies into premiums on yourself, think through the beneficiary designations on whether you might be able to perpetuate those gifts to help many generations in the future, instead of naming just the people who exist today, and maybe people who are yet unborn, and extend your legacy through your gifts today. All right, folks, I don't want you to forget about the 0% capital gains tax rate on gifts today. I want you to do a lot of calculations between now and the end of the year. Good luck, because you only have about 2 days for that after listening to the show. But again, this is what I do all year long. Try to share with you strategies, help you make the most out of what you have. And I appreciate you all tuning in. We'll be back again next year. Thanks for listening. This is another edition of All Things Financial.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through SagePoint Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with SagePoint Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.